So, if you sell your used Honda City tomorrow and, like, by some absolute miracle of the secondhand car market, you actually sell it for more than you paid for it, the tax man does not care.
No, not at all.
Right. He won't ask for a single rupee of that profit. But if you sell a painting that's just been hanging quietly in your living room for 5 years, suddenly the government is knocking on your door demanding a cut of the gains.
Yeah, they absolutely want their piece.
Which is wild. So, welcome to the illogical, fascinating, and frankly terrifying world of Chapter 8 of the NESM series XB syllabus, which is capital gains.
It really does seem illogical on the surface, like why the painting and not the car. But once you actually understand the underlying machinery of the Indian tax code, you start to realize it's a highly calibrated, very deliberate system.
It feels like the final boss in a video game to me.
That is exactly what it is. It's intricate, it's unforgiving, and it is absolutely foundational to understanding wealth management and taxation in India.
Hmm.
But, I mean, that is exactly why we're not going to let it intimidate us today. We are going to dismantle this chapter, like piece by microscopic piece.
And that is exactly why you are here, because you are the financial mentor for this deep dive, and I'm stepping into the shoes of the eager, maybe slightly overwhelmed student staring down the barrel of this certification exam.
You'll be fine, I promise.
I hope so. And to you listening right now, consider this your formal invitation to, mentally pull up a chair to this intensive zero fluff study session, because we have a very strict mission today.
Yes, we do.
We are not just skimming this text. We're not doing some generic top 10 takeaways list. We are going to break down every single definition, every exhaustive list, every formula, and every exception. We are going to bulletproof this knowledge.
I completely agree with those ground rules. I mean, no skipping, no summarizing. If the Income Tax Act provides a list of 10 items, we're discussing the mechanics and the history of all 10 of those items.
Awesome.
Yeah, so we're going to tackle the massive July 23rd, 2024 tax amendments, the sprawling list of exemptions, and exactly how the law defines what is and isn't a capital asset. And most importantly, we're going to explain why these rules exist. Because, memory really relies on understanding the logic, not just rote memorization.
Right, totally. So let's start right at the foundation. Before we can calculate any taxes or talk about rates or indexation, we need to know what is actually being taxed in the first place.
Exactly.
So let's look at sections 8.1 and 8.2. What is the official legal definition of a capital asset under Section 214 of the Income Tax Act? Because I literally need to know if, the laptop I'm looking at right now is going to cost me tax if I sell it.
Okay, so under Section 214, the textbook definition of a capital asset is remarkably, I'd say almost aggressively broad. Okay, lay it on me.
It is defined as property of any kind held by an assessee, whether or not connected with his business or profession.
Wait, property of any kind.
Notice the phrasing, yeah. Property of any kind.
Okay, let's pause right there because property of any kind sounds like literally everything I own, like my clothes, my shoes, my coffee mugs. And just to be clear for the absolute beginners listening, when the text says held by an assessee, that just means the taxpayer, right?
Yes, exactly. The assessee is just the person or entity being assessed for tax, the taxpayer.
Okay, got it.
And yes, the starting presumption of the Income Tax Act is literally that everything you own is a capital asset. They cast the widest possible net first.
That's terrifying.
It is, but before we get to the exclusions, which, spoiler alert, will save your coffee mug and your clothes from taxation, we need to talk about the specific inclusions mandated by financial regulations. Because the government explicitly calls out certain financial instruments, so there is just zero ambiguity.
I have my notebook ready. What are the specific inclusions? Okay, flag this first point for the exam immediately.
Flag.
The Act explicitly includes any securities held by a foreign institutional investor, or FII, which, by the way, are now more commonly referred to as foreign portfolio investors, or FPIs.
Right.
So securities held by them who have invested in such securities in accordance with SEBI regulations. That is explicitly a capital asset.
Well, wait, why do they specifically call out foreign investors? I mean, isn't a share just a share no matter who owns it?
You'd think so, but it's really about classifying the nature of the income. Historically, there was massive drawn-out litigation over whether foreign funds trading in Indian markets were generating business income or capital gains.
Does the label actually matter that much?
Oh, massively. Business income is taxed at a much higher corporate rate. Capital gains enjoys lower rates to encourage investment. So by explicitly stating that any securities held by FPIs are capital assets, The government just ended the debate. It guarantees these foreign investors get the beneficial capital gains tax rates.
Oh, I see. So it keeps the foreign capital flowing smoothly into Indian markets.
Exactly. It's a legal shield for foreign money.
That makes a lot of sense. Okay, what else is explicitly included?
Flag this one for the exam as well. Any securities held by a Category 1 or Category 2 Alternative Investment Fund, or AIF, which has invested in accordance with SEBI regulations.
Okay, jargon alert. Before we move on, what exactly is a Category 1 or 2 AIF? Give me the explain it like I'm 5 version.
Sure. An alternative investment fund is basically a massive pool of private capital, usually from high net worth individuals, that invests outside the traditional stock and bond markets.
Like private equity stuff.
Exactly. Category 1 AIFs invest in startups, early-stage ventures, social ventures, or infrastructure, basically areas the government considers economically desirable.
Okay. And Category 2?
Category 2 AIFs are private equity funds or debt funds that don't take on leverage for investments. So similar to the FPI logic we just talked about, the government explicitly defines their holdings as capital assets to provide tax certainty.
So it just guarantees the pass-through benefits to the wealthy investors funding those crucial sectors.
It nails it.
Got it. Startup funds and private equity. What is the third specific inclusion?
Okay, this is a very recent addition and highly testable. Any unit-linked insurance policy, or ULEAP, to which the exemption under Section 10D does not apply.
Wait, ULEAPs?
Yeah, these are commonly referred to as high-premium ULIPs. The Finance Act of 2025 actually amended the provisions to clarify that any ULEAP to which the exemption doesn't apply will be considered a capital asset.
Starting when?
This amendment takes effect from financial year 2025 to 2026.
Okay, let me push back on this a little. Because a ULP is essentially a life insurance policy combined with a mutual fund investment, right?
Right, it's a hybrid product.
And historically, life insurance payouts were completely tax-free under that Section 1010D. So why is the government suddenly calling these high-premium ones capital assets and taxing them?
It's a really fascinating shift in policy, actually. Historically, insurance was meant for protection, to provide for a family if the breadwinner passed away.
Yeah, of course.
And the tax exemption was there to encourage that social safety net. But wealthy individuals realized they could pump massive amounts of money, like millions of rupees, into these ULPs.
Ah, I see where this is going.
Yeah. Because it had this tiny life insurance component attached to it, the massive investment returns were entirely tax-free. It literally became a loophole for the rich to dodge mutual fund taxes.
Wow.
So the government stepped in and said, look, if your premium is incredibly high, you aren't buying insurance for protection. You are making an investment. Therefore, the exemption is stripped away, and it is now explicitly treated as a taxable capital asset.
I love that. They just closed the billionaire loophole.
Exactly.
Okay, so we have FPI securities, Category 1 and 2 AIFs, and high-premium ULPs post-FY 2025-26. But the text also lists out specific types of property that fall under this umbrella, right? It's not just financial instruments.
Correct. The Act provides specific inclusions to remove any ambiguity regarding, like, intangible or unusual assets.
Like what?
Well, a capital asset includes all kinds of properties, movable or immovable, tangible or intangible. It specifically includes rights of management or control of an Indian company.
Okay.
It includes a business undertaking, a partner's share in a firm, and a route permit.
Wait, hold on. A route permit. How is a permit a piece of property?
Think of a private bus operator in India. To operate a bus between two major, highly lucrative cities, let's say Mumbai and Pune, you need a government-issued route permit.
Right.
Because the number of permits is restricted to prevent overcrowding, holding that piece of paper gives you a monopoly-like advantage on that route. That piece of paper holds immense commercial value.
Oh, I see. Because you can just sell the paper itself.
Exactly. You can sell that permit to another bus operator for a massive premium. The tax department recognizes that value, so they classify that permit as a capital asset.
Yeah.
If you sell it, you pay capital gains tax.
That is wild, but it's totally logical. The right to make money is itself an asset.
Exactly.
Keep going with the list. What else?
It also includes a leasehold right, the right to get a conveyance executed, the right to subscribe to shares of a company, goodwill of a business, a license to manufacture, and of course the classics.
Which are?
Gold, jewelry, and securities.
Okay, let me unpack this because I still have my initial concern from the start of the deep dive. The definition is property of any kind and includes movable and tangible things. So we are back to my first question. Is my sofa a capital asset?
No.
What about the clothes I'm wearing? Or my car parked outside? Like if I sell my used PlayStation to a friend, am I supposed to be filing a capital gains tax return?
That is an excellent question, and this is exactly where the tax code introduces a heavy dose of common sense.
Huh.
This brings us to the exclusions. The law is not interested in tracking the sale of your used PlayStation.
Thank goodness.
The first major exclusion from the definition of a capital asset is personal effects.
Okay, define personal effects for me.
They are defined as movable property held for personal use by the assessee or any member of their family dependent on them.
Okay, so that covers the sofa.
Yes. The text specifically cites examples. Wearing apparel, furniture, your car, a scooter, your TV, your refrigerator, musical instruments, a gun, a revolver, or a generator.
A revolver, wow. Very specific.
Yeah. As long as these are intended for personal or household use, even if you don't use them every single day, they are personal effects. And therefore, they are completely excluded from being capital assets.
Okay, so the Honda City example from the beginning of the show. If I buy a Honda City for personal commuting, use it, and eventually sell it, it's a personal effect. No capital gains tax, even if I magically sold it for a profit.
Correct. Zero tax on that.
Nice. What about things I use for my business, but I don't hold them as investments, like raw materials for my factory?
That is the other major exclusion. Stock and trade.
Okay.
Any stock and trade, consumable stores, or raw material held for the purpose of your business or profession is completely excluded from the purview of a capital asset.
So how is that taxed then?
If you are a jeweler, gold is your stock in trade. When you sell a gold necklace, that is treated as business income, not capital gains. The intent behind holding the asset changes its classification entirely.
Okay, so personal clothes, my scooter, raw materials, none of these are capital assets. But let me try to find a loophole here. What if I have an incredibly expensive Rolex watch? Or like, my wife has a diamond necklace. Those are movable. We wear them personally. Do those escape the tax net as personal effects?
You've walked right into the trap.
Uh-oh.
And I want you to flag this for the exam in bright red ink. This is the exception to the exception.
Of course there is.
The Income Tax Act specifically targets high-value personal items that tend to appreciate in value, unlike a used car or a TV, which depreciate.
Right, because a Rolex goes up in price.
Exactly. The government realized people were parking massive amounts of black money in high-end luxury items and claiming them as personal effects. So the following assets, even if they are purely meant for personal use, are not considered personal effects.
And any gain from selling them is charged to tax.
Yes. There are 6 specific categories here. Actually, let's break them down.
So these are the things that are always capital assets no matter how much you use them. Let's list them.
Number 1 is jewelry. And the definition is incredibly exhaustive to prevent loopholes.
How exhaustive?
It includes ornaments made of gold, silver, platinum, or any other precious metal, whether or not worked or sewn into any wearing apparel.
Wait, sewn into apparel, so if you sew gold thread into a wedding sari, that sari is now jewelry?
Legally, yes. That sari is now a capital asset.
Wow. They really thought of everything. Okay, what's 2?
Number 2 is precious or semi-precious stones, whether or not set in any furniture, utensil, or sewn into apparel.
Okay, stones. Number 3.
Number 3, archaeological collections. Number 4, drawings. Number 5, paintings. Number 6, sculptures. And number 7, any work of art.
Okay, let me lock this in with a relatable scenario for the listener. Let's talk about the painting from the intro. If I buy an M.F. Hussein painting to hang in my living room, I am not an art dealer. I just like looking at it. It is entirely for my personal enjoyment.
Right.
If I sell it 5 years later for a massive profit, that is taxed. Why? Because historically, paintings are a phenomenal store of value, and the government knows wealthy individuals use fine art as an alternative asset class to park wealth. So paintings are an explicit exception to the personal effects rule. They are capital assets.
Precisely. You understand the intent behind the law perfectly now.
Okay.
Now, there are 2 more major exclusions from the definition of a capital asset that we absolutely must cover.
Okay, what's next?
Next one is rural agricultural land in India.
Rural being the operative word there, I assume.
Exactly. India is an agrarian economy at its core, and the tax code protects farmers. Any agricultural land situated in a rural area in India is not a capital asset.
So if a farmer sells his rural land, there is zero capital gains tax.
Correct. But the Act is very careful to define what is not rural. Agricultural land is considered a taxable capital asset if it's situated in an urban area in India or within the prescribed limits of a municipality, or if the agricultural land is situated in a foreign country.
Ah, okay. So if I'm a wealthy businessman and I buy a farmhouse on the outskirts of Delhi that technically falls within municipal limits, that's a capital asset. I can't claim I'm just a poor farmer.
Exactly. You can't use that loophole.
But buying actual farmland deep in rural Punjab outside any municipal jurisdiction, that is genuinely not a capital asset.
Correct. The law looks at the population and the distance from the local municipality to determine if it's truly rural.
That makes sense. And what's the final exclusion?
Flag this for the exam because there is a very specific list of 6 bonds that are excluded from being capital assets.
List of them. Okay.
The examiner can easily slip a fake bond name into a multiple choice question to trick you. So we are going to go through all 6, and I will explain why they exist.
Read them out. I am writing them down, and I definitely want the history lesson for context.
Number 1, 6.5% gold bonds, 1977. Number 2, 7% gold bonds, 1980. Number 3, national defense gold bonds, 1980.
Let's pause right there. Why all these gold bonds from the late 70s and 1980? Like, what was happening back then?
You have to look at the macroeconomic situation of India at the time. The country was facing severe foreign exchange shortages.
Right.
The government desperately needed citizens to part with their physical unproductive gold sitting in lockers at home just to bolster the national reserves. So they issued these sovereign bonds.
Okay.
They offered decent interest rates, but as a massive sweetener, they promised that if you bought these, you would never pay capital gains tax when you eventually redeemed or transferred them. The tax exemption was the carrot to pull physical gold into the formal banking system.
That is brilliant context. It makes it so much easier to remember why those specific years are there. Okay, what are the last 3?
Number 4, special bearer bonds, 1991. And the history here is even more dramatic.
Oh, I love financial drama. Hit me.
In 1991, India faced a catastrophic balance of payments crisis. We were literally weeks away from defaulting on international loans. The government needed money desperately.
So what did they do?
The special bearer bonds were essentially an amnesty scheme to mop up black money. You could buy these bonds with unaccounted cash, no questions asked, and they were entirely exempt from wealth tax and capital gains tax.
Amazing. Just a total free pass to save the economy.
Exactly.
And the final 2.
Number 5, gold deposit bonds issued under the Gold Deposit Scheme, 1999. And number 6, deposit certificates issued under the Gold Monetization Scheme, 2015.
Okay, 2015 is pretty recent.
Yes. These last 2 are modern iterations of the exact same concept, trying to get India's massive household gold reserves into the banking system to reduce our reliance on importing foreign gold. By declaring them not capital assets, the government makes them highly attractive to investors.
Okay, let me repeat the list to lock it in for myself and everyone listening.
Go for it.
1977 gold bonds, 1980 gold bonds, 1980 defense bonds, 1991 special bearer bonds, 1999 deposit scheme, and 2015 monetization scheme certificates.
Perfect.
So if I sell any of these, no capital gains tax because the law refuses to recognize them as capital assets in the first place.
Exactly right. And with that, you have officially mastered sections 8.1 and 8.2. You know exactly what is on the table to be taxed and the logic behind why certain things are shielded.
Excellent. I feel smarter already. So now that we know what an asset is, let's move to section 8.3, which gets into the timing.
Yes, the clock.
Right. Because knowing what you own is only half the battle. How long you hold an asset completely changes the tax rate you are going to pay. We're talking about the famous short-term versus long-term divide.
A very important divide.
And I know the Finance Act of 2024 really shook this up. It was all over the financial news. How are the lines drawn now?
They shook it up significantly. The government really aimed for massive simplification here. But first, we must establish the baseline. Everything we're about to discuss assumes the sale of the capital asset happens on or after July 23, 2024.
Okay, so that's the cutoff.
Yes. The old rules, which had incredibly confusing 36-month tiers for certain assets, apply before that date. But for the exam and for any practical planning today, July 23rd, 2024 is day zero for the new regime.
July 23rd, 2024. Etched in my brain.
Yeah.
So what is the new general rule?
The general rule is beautifully clean now. A holding period of 24 months or less is a short-term capital asset. A holding period of more than 24 months is a long-term capital asset. 24 months is the standard dividing line across the board.
Okay, that sounds way too simple for the Indian Income Tax Act.
You know them well.
Yeah, the government loves to complicate things. Where are the exceptions?
Right on cue. Exception 1 is the 12-month rule.
Okay, tell me about that.
The government wants to encourage long-term capital formation in formal financial markets. So certain financial assets enjoy a fast track. They become long-term and thus eligible for lower tax rates after you hold them for just more than 12 months.
Oh, that's a nice perk. Who gets the fast track?
There are exactly 7 items on this VIP list.
Let's hear the VIP list.
A. Listed shares of a company. This means equity or preference shares listed on a recognized stock exchange in India.
Okay.
B. Listed securities. This includes debentures, bonds, derivatives, or government securities that are listed. C. Units of UPI, whether listed or unlisted.
Got it.
D. Units of an equity-oriented fund, whether listed or unlisted.
Pause on D. What qualifies as an equity-oriented fund?
Simply put, it's a mutual fund that invests a minimum of 65% of its total proceeds in the equity shares of domestic companies.
Ah, okay.
Because they take on equity risk, the government rewards them with a 12-month fast track.
Makes sense. Let's continue.
E. Zero coupon bonds, whether listed or unlisted.
Define zero coupon bond for me. Because I hear bond and I immediately think of regular interest payouts.
It's a bit different. A zero coupon bond pays zero interest or zero coupons during its lifespan. Instead, it is issued at a deep discount to its face value, and you redeem it at full face value at maturity. The difference is your profit.
Oh, interesting. Why the fast track for them?
The government grants these the 12-month rule to encourage infrastructure companies to raise long-term capital without the burden of servicing regular interest payments.
That makes a lot of sense. What are the last 2 VIPs?
F. The ULPs to which the 10D exemption does not apply, issued on or after February 1st, 2021 and before April 1st, 2025.
Okay, the middle era ULPs.
Yes. And finally, G. High premium equity-oriented ULPs issued from FY 2025 to 2026 onwards. If you hold any of these 7 items for more than 12 months, congratulations, they are long-term.
Okay, so my listed shares of Tata Motors become long-term after just 1 year. That's a huge benefit. But what about the other extreme?
The penalty box.
Yeah. Are there assets that the government hates so much they are just permanently trapped as short-term, no matter how long I hold them?
Flag this for the exam. Exception 2 deals with exactly that. No criteria of period of holding. These are always treated as short-term capital assets, irrespective of whether you hold them for 1 month or 20 years.
Whoa, okay. There are 3 major categories here, right? Let's find out what the government wants to penalize.
First, a depreciable asset is always treated as a short-term capital asset.
Wait, why? If I hold a piece of factory machinery for 10 years, why doesn't it become long-term?
Because you have been claiming depreciation on it every single year, reducing your business income tax. You've already received massive tax benefits during the holding period.
Oh, I see.
The government says you don't get to double dip and claim long-term capital gains benefits when you finally sell it. It's an anti-abuse measure.
Oh, that makes perfect sense. No double dipping. What's the second one?
Gains arising from the transfer, redemption, or maturity of market-linked debentures or MLDs or units of specified mutual funds, SMFs, acquired on or after April 1st, 2023. Those are always short-term.
Again, why the specific targeting of MLDs and SMFs? Like, what is a specified mutual fund anyway?
A specified mutual fund is essentially a debt mutual fund. It's a fund that invests not more than 35% in equity shares.
Okay.
Historically, wealthy investors would park billions in these debt funds and hold them for 3 years to get long-term capital gains tax rates, effectively beating the tax rates on standard bank fixed deposits.
Oh, so it's a massive arbitrage.
Precisely. The government decided to level the playing field between bank FDs and debt mutual funds. By forcing MLDs and SMFs to always be short-term, they are taxed at your standard income tax slab rate, completely destroying the arbitrage.
Wow. The tax code is essentially an arms race between clever accountants and the government.
It really is.
And the third category.
Thanks to the 2024 amendment, where an unlisted bond or unlisted debenture is transferred or matures after July 23rd, 2024, the gains shall be taxable as short-term under Section 50 JLA.
Meaning?
This again targets private debt structuring used by high net worth individuals to create artificial tax advantages. Unlisted bonds are now permanently short-term.
Okay, let's drill through Table 8.1 to lock this in conceptually. I'm going to throw out an asset class, and you tell me the holding period required for it to be considered long-term. Ready?
Let's do it.
Unlisted equity shares. Let's say I buy equity in my friend's private tech startup.
24 months. Remember, the 12-month fast track is only for listed equity shares. Unlisted equity requires 24 months because the government wants to ensure it's serious capital, not short-term speculation in private markets.
Got it. Units of REITs or INVEETs. And quickly, what are those again?
REIT stands for Real Estate Investment Trust, and INVEET is an infrastructure investment trust. Think of them like mutual funds, but instead of buying stocks, they pool money from investors to buy income-generating real estate like massive office parks or infrastructure projects like toll roads.
Awesome. And their holding period?
For their holding period, if they are listed on an exchange, it requires 12 months. If they are unlisted, it requires 24 months.
Okay. Unlisted equity mutual funds.
12 months. As long as it is an equity-oriented fund, whether listed or unlisted, it enjoys the 12-month rule.
Physical gold bars.
24 months. It falls under the general rule.
Immovable property, like buying a plot of land or a commercial building.
24 months.
Okay, so to put it in a real-world context for you listening, if I buy listed shares of a major bank on the NSE, I hit the long-term threshold at 12 months.
Right.
If I buy unlisted shares in my cousin's startup, I have to wait 24 months to get that long-term tax treatment. And if I buy a specified debt mutual fund after April 2023, I could hold it until the sun burns out, and it will still be taxed as short-term at my maximum slab rate.
You've summarized the landscape perfectly. But now we actually have to move to Section 8.3.1, which introduces a very practical, almost mechanical problem.
Right. It's easy to say 12 months or 24 months, but exactly which date do I start counting from?
Exactly.
And when do I stop? Is it the day I clicked buy on my trading app, the day the shares hit my DMOT account, the day the money actually leaves my bank account? The clock starting and stopping has to be standardized, or else it would be pure chaos.
It is heavily standardized, precisely to avoid that chaos. The period of holding is generally calculated from the date of purchase till the date of its transfer. But Table 8.2 outlines the special provisions for complex scenarios.
Let's work through them.
Let's start with market transactions. For listed shares sold through a broker on an exchange, the date of the broker's note is considered the date of purchase and sale.
Okay, as long as it goes through, right?
Yes, provided it's followed up by actual delivery of the shares.
Okay, broker's note date. What if I bypass the exchange? What if I transfer listed shares directly to another party off-market?
Then the period of holding is counted from the date of the contract of sale as declared by the parties.
Yeah.
And again, provided it's followed by actual delivery.
That makes sense. Now, what about my DMAT account? Because this is the one that confuses everyone, including me.
It's a common stumbling block.
If I bought 100 shares of Reliance in 2020, then I bought another 100 shares of Reliance in 2023, they are all sitting in the exact same DMAT account looking identical.
Right.
In 2025, I decided to sell 50 shares. Which ones did I sell? The old ones or the new ones? Because selling the 2020 ones gives me long-term capital gains, but selling the 2023 ones might not. Can I just choose which ones to sell?
Flag this for the exam in bright red ink. You absolutely cannot choose. For securities held in DMAT form, the holding period is determined purely by the first-in, first-out method, or FIFO. The securities that first entered into the DMAT account are legally deemed to be the first ones sold out.
So if you are listening, imagine your DMAT account like a physical queue of commuters waiting for a bus. The share that got in line first back in 2020 is at the very front of the queue.
That's a great way to picture it.
Right. So when you hit the sell button for one share, that 2020 share is the one that gets pushed onto the bus. You cannot manually walk to the back of the line and choose to sell the 2023 share just to intentionally trigger a short-term loss for tax harvesting, for example.
No. The system forces first in, first out.
That is an excellent visualization. It explains exactly why the government mandated FIFO to prevent investors from cherry-picking their tax outcomes.
Exactly. Now let's look at corporate actions. How do we count the holding period for bonus shares?
Well, bonus shares are essentially free shares given to existing shareholders by the company out of its accumulated profits. I didn't actually buy them on a specific date, so when does the clock start?
The period of holding for bonus shares is reckoned from the date of allotment of those bonus shares by the company.
Okay. date of allotment.
Similarly, for sweat equity shares, or shares issued under ESOPs, the period is reckoned from the date of allotment or the date the shares are issued upon exercise of the option.
Let me define sweat equity quickly for the listeners. It's equity given to employees or directors at a discount or for consideration other than cash, basically for providing their sweat, their know-how, hard work, or intellectual property.
Right.
So the clock starts when they are officially allotted. What about right shares, where the company gives me the right to buy more shares at a discount to the market price?
The holding period for the actual right shares you subscribe to is counted from the date of allotment of those right shares.
Okay, straightforward.
But what if you don't want to buy them? What if you sell your right to subscribe to someone else?
Yeah. Oh, you can do that.
Yes, that is called a renouncement of right. The right itself is a capital asset. For the person selling the right, the holding period of that right is reckoned from the date of the offer made by the company to the date of renouncement.
Okay, let's move to conversions and restructuring. What if I hold preference shares and they are eventually converted into equity shares? When does the clock start for the new equity shares? Does it reset to day zero?
This is a crucial benefit for the investor. The period for which the preference shares were held by the assessee is actually included in the period of holding of the newly converted equity shares.
Oh, so the clock doesn't reset. If I held the preference shares for 5 years, the moment they turn into equity shares, those equity shares already have a 5-year holding period.
Exactly. And why? Because your underlying economic interest in the company hasn't actually changed, just the form of the instrument.
That's surprisingly fair.
The same logic applies to the conversion of bonds or debentures into shares. The holding period of the original asset is taken into consideration. It also applies to shares of an amalgamated company. You include the period you held shares in the original amalgamated company.
What about a demerger?
In a demerger, the period you held shares in the demerged company is included in the holding period of the shares of the resulting company. Even for units of a business trust allotted in exchange for shares of a special purpose vehicle, the SPV holding period is included.
So the overarching philosophical theme here for conversions and corporate restructuring is the tax department basically lets you grandfather in your original holding time. They don't penalize you by resetting the clock just because the corporate structure changed above your head.
Precisely. And finally, under this section, operation of law. What happens if you acquire an asset through an inheritance, under a will, or as a gift?
Right. If my grandfather gifts me his physical gold bars today and I sell them tomorrow, is that a one-day holding period? Because that would make it a short-term capital gain, and I'd be taxed at my slab rate, which is awful.
No, thankfully. Under Section 49(1), the period of holding of the last previous owner who actually acquired the asset by way of purchase is included.
Oh, wow.
Your grandfather's holding period is added to yours. So if you bought it 20 years ago and you hold it for one day, it is treated as a long-term capital asset when you sell it, and you get the beneficial long-term tax rates.
That is incredibly important to know. Okay, so we have the asset defined. We know exactly how to measure the time we've held it, right down to the specific start and end dates.
We do.
But Segment 4 asks the critical trigger question. What actually constitutes a transfer? Because I don't pay tax just for owning something. The tax is triggered by an event. Section 8.4 dives into this. Is it only when money changes hands in a traditional sale?
In general parlance, transfer just means passing property from one person to another. But Section 247 of the Income Tax Act defines it much more broadly to prevent evasion.
How broad are we talking?
It includes the obvious. A sale, where property is exchanged for an agreed consideration, or price. It includes an exchange, where two persons mutually transfer the ownership of one thing for another. Barter, essentially.
But the text also lists relinquishment of asset and extinguishment of rights. Those sound like serious legal jargon. What do they mean practically?
Let's use scenarios. A relinquishment occurs when the owner withdraws themselves from the property and abandons their rights to it in favor of someone else.
Give me an example.
The text gives a great one. Mr. A and Mr. B enter a partnership and contribute assets. Later, Mr. A retires and relinquishes his rights and interest in the partnership property in favor of Mr. B. Even though it wasn't a traditional sale, that relinquishment is a transfer and is chargeable to capital gains tax.
Ah, I see. And extinguishment. How is that different?
Extinguishment is when the rights of a person in a capital asset are destroyed or put to an end, even if the asset itself hasn't necessarily been handed to someone else.
Okay, wait. If my car is destroyed in a crash, is that an extinguishment?
Let me be clear on that.
Yeah.
If your car is irretrievably lost or destroyed in a flood or a crash, That doesn't mean you suffered a capital loss under this head.
Right.
But specific corporate actions, like a capital reduction where a company legally reduces its share capital and cancels your shares, that extinguishes your rights. That is treated as a transfer.
Wow.
Finally, the maturity or redemption of zero-coupon bonds issued by infrastructure capital companies is explicitly treated as a transfer by the Act.
Okay, so the definition of a transfer is incredibly aggressive. It covers almost any way an asset leaves your possession. But this brings us to Section 8.4.1.
The non-transfers.
Right, and we agreed at the top of the show, no summarizing. This is the list of transactions not regarded as transfer. These are the safe havens where you can move an asset, and the taxman basically says, we'll look the other way for now.
I am ready.
You must walk me through all 10 of these non-transfer events, and more importantly, tell me why the government allows them.
I will rigidly enforce the rule. Let us go through all 10. Number 1. Any distribution of a capital asset on the total and partial partition of a Hindu undivided family, or HUF.
Let's pause. For listeners not familiar with Indian personal law, an HUF is a unique legal entity consisting of lineal descendants of a common ancestor. When the family decides to split up and divide the ancestral property among the co-partners, the joint heirs, why is that not a transfer?
Because the co-partners already had a pre-existing right to that property by birth. It isn't a sale to a third party. It is just a formal division of what they collectively already owned. Taxing a family partition would be unjust and culturally disruptive.
That makes sense. Okay, number 2.
Number 2. Any transfer of a capital asset under a gift or will or an irrevocable trust. If you gift an asset to your son or leave it in your will, it is not a transfer for capital gains purposes for you.
Wait, I see an exception to that in the text.
Yes, excluding shares, debentures, or warrants allotted under an employee's stock option plan or ESOP that are gifted.
Why the exception for ESOPs?
Because ESOPs are a form of employee compensation. The government doesn't want an executive receiving millions in stock options and then quietly gifting them to a spouse to avoid taxation on what is essentially salary. Gifting ESOPs doesn't get this protection.
Clever. Okay, number 3.
Number 3, transfer among non-residents. If a non-resident transfers specific Indian securities to another non-resident outside India, it is not charged.
What kind of securities?
This includes transferring bonds, JDRs, rupee-denominated bonds, or derivatives in an international financial services center, an IFSC, provided the consideration is paid in foreign currency.
And the why here?
The why here is simple: to promote India's IFSCs, like Gift City, as global financial hubs, taxing offshore transactions between non-residents would just kill the market.
Makes total sense. What's number 4?
Number 4, redemption of sovereign gold bonds. If an individual redeems a sovereign gold bond issued by the RBI, it is not regarded as a transfer. Again, this is the carrot to encourage citizens to invest in paper gold rather than physical gold.
Got it. Number 5.
Number 5, conversion of securities. We touched on this during the holding period discussion. Converting bonds or debentures into shares, converting foreign currency exchange bonds into shares, or converting preference shares into equity shares, none of these are treated as a transfer.
Because it's just changing form.
Yes, the taxation is deferred until you finally sell the new shares because you haven't realized any actual cash profit yet.
That logic holds up. We are halfway through the list. What's number 6?
Number 6, consolidation of mutual fund schemes. SEBI regularly pushes mutual fund houses to consolidate multiple confusing schemes into single, clearer schemes.
Right.
To promote this consolidation, the Income Tax Act provides that merging units of one similar scheme into another is not a transfer. The investor didn't ask for the merger, so they shouldn't be slapped with a tax bill for it.
That's totally fair. 7.
Number 7, lending of securities. Under the SEBI Securities Lending and Borrowing Scheme, the SLB, if you lend your shares to a borrower through an approved intermediary for a fee, and they return equivalent securities later, that lending action is not a transfer.
Even though the shares left my account?
Even if you don't get the exact same distinct numbered share certificates back, it is exempt. This is done to provide liquidity to the markets for short selling without triggering massive tax events for the lenders.
Okay. 8.
Number 8, rollover of fixed maturity plans, or FMPs. Historically, AMCs could roll over an FMP to extend its duration beyond 24 months to help investors get long-term tax benefits. This wasn't considered a transfer.
You say historically?
Yes, I must note the text explicitly states this is largely irrelevant now.
Why is it relevant?
Because, as we discussed earlier, schemes investing heavily in debt are now always treated as short-term under Section 50AA. Since the long-term benefit is gone, the rollover exemption has basically lost its practical utility.
Okay. Moving on. Number 9.
Number 9, distribution in case of liquidation. If a company goes bankrupt or liquidates and distributes its physical assets to shareholders, the company is not taxed on that transfer. However, the shareholders receiving the assets are liable to pay tax on any capital gains arising from it.
So the dying company escapes, but the shareholder gets caught. Got it. And the final one.
Number 10, conversion of gold into electronic gold receipts, or EGR, or vice versa. Converting physical gold into an EGR issued by a vault manager or turning that EGR back into physical gold is not treated as a transfer.
Why did they add that?
This is purely to align with the government's Digital India push, making gold trading electronic and transparent.
Okay, let's tie this back to the grandfather example from earlier to make sure the concept is crystal clear for the listener.
Good idea.
If my grandfather gifts me a house through his will under item number 2 on this list, that act of him giving it to me is not a transfer. There is no capital gains tax triggered at the moment of inheritance. But, linking it back to our earlier segments, the house is still a capital asset, and my holding period includes his holding period.
Yes.
So if I decide to sell that house to a third party 5 years from now, that sale is a transfer, and I will pay capital gains tax based on the combined holding time.
Exactly. The tax isn't eliminated, it is just deferred until a qualifying transfer event occurs. You are seeing how all these sections intricately interlock. Which brings us, inevitably, to Segment 5, the math, Section 8.5.
The computation of capital gains. I need you to walk me through the actual equation. I have defined the asset, I have calculated the holding time, and I have executed a valid transfer. How do I calculate the final taxable amount?
Okay, I want you to visualize a top-to-bottom subtraction column, like a simple grocery receipt.
Okay, I'm picturing it.
You start at the very top with the gross amount, and you subtract specific allowances line by line until you reach the final, smaller taxable number at the bottom.
All right, what's step 1?
Step 1, the top line, the full value of consideration. This is the total amount you received, or are entitled to receive, for selling the asset.
Okay.
From that top number, you are legally allowed to subtract 3 specific things. First, expenditure incurred wholly and exclusively in connection with the transfer. Second, the cost of acquisition, or COA, what it costs you to buy it. And third, the cost of improvement, or COI, what it costs you to upgrade it.
And what's left at the bottom?
What you are left with at the bottom is your capital gain, or capital loss.
Okay, let's break down each of those variables, starting with the top line. Full value of consideration. Usually that's just the sale price, right? If I sell a share for 100 rupees, the consideration is 100. Why does it need a special definition?
Usually, yes, it's the commercial price. But Table 8.3 outlines special cases where the government does not trust your stated sale price, so they dictate what the full value is to prevent tax evasion.
Give me an example.
For example, if you convert a capital asset into stock and trade for your business, you aren't actually selling it to anyone. You are moving it between your own accounts. In this case, the consideration is deemed to be the fair market value, or FMV, of the asset on the date of conversion.
What about private transactions? Like, what if I sell shares of my private company to my brother for pennies just to dodge tax?
Precisely why the rule exists. If you transfer unquoted shares for less than their fair market value, the tax department will completely ignore your stated sale price and use the fair market value as the full value of consideration.
Gotcha. What about ESOPs?
If securities allotted under an ESOP are gifted, the market value of those securities on the date of the transfer is considered the full value. Again, preventing executives from dodging tax by gifting stock options.
Okay, moving down the subtraction column. The first deduction is expenditure incurred wholly and exclusively in connection with the transfer. Now, I want to lower my tax bill as much as possible. What counts here?
Things like brokerage or commission paid to a broker to execute the trade, stamp duty, registration fees for real estate, traveling expenses directly related to executing the sale, and legal expenses for drafting the transfer documents.
Oh, sweet. So I can deduct STT too, right? I paid that.
No, and flag this for the exam immediately. There are absolute exclusions. No deduction is allowed for any sum paid on account of securities transaction tax, STT, or commodities transaction tax, CTT. You absolutely cannot deduct them.
But why not? It was an expense of the trade.
Because STT and CTT are regulatory taxes levied by the government, not operational commercial expenses. The government refuses to subsidize a tax they levied by allowing you to deduct it from another tax.
Fine, fair enough. What about the fees I pay to my investment advisor? Like the guy who told me to buy the stock in the first place. Can I deduct his fee?
The text specifies that investment advisor fees are most likely not allowed as a deduction, unless you can prove beyond a shadow of a doubt that they're directly related to the specific asset and can be directly connected with the transfer itself. General portfolio advisory fees do not count. The expenditure must be wholly and exclusively for that specific transfer.
Okay, the second deduction on a receipt is the cost of acquisition, the COA. Basically what I paid to buy the thing. But Table 8.4 is huge. Let's talk about the special cases here.
The overarching rule is that your COA is your purchase price. But there are historical adjustments. For any asset acquired before April 1st, 2001, the assessee has a choice. They can take the actual purchase price or the fair market value as of April 1st, 2001, whichever is higher.
Just to combat inflation, right?
Exactly. It protects people from inflation over incredibly long holding periods.
Okay, but the big one, the one that trips everyone up on the exam and in real life, is the 2018 grandfathering clause for equity shares. Walk me through this formula, and I want an analogy. How should I visualize this?
Think of it like a save point in a video game.
A save point.
Yeah. If you are playing a game and you hit a save point on January 31st, 2018, everything you achieved up to that point is locked in and protected. If you die later in the level, you don't lose the progress you made before the save point.
Okay, I'm following.
The government introduced long-term capital gains tax on equities in 2018, but they didn't want to retroactively tax people on profits they made before the law existed. So they created a save point.
Who does this apply to?
This applies to equity shares, equity-oriented mutual funds, or business trust units that are chargeable to STT, which you acquired before January 31st, 2018, and sold after April 1st, 2018. The government essentially wiped out the tax on any gains made up to January 31st, 2018.
Okay, what is the actual math formula to calculate this save point cost of acquisition?
I will be very precise here. The formula for the new cost of acquisition is the higher of two numbers. Let's call them A and B.
Okay, what's A?
Number A is the actual cost of acquisition.
Simple. What's B?
Number B is the lower of the fair market value on January 31st, 2018, or the full value of consideration, which is the sale price.
Okay, I am going to provide a dummy portfolio example to lock this in. Let's say I bought a share in 2015 for 100 rupees. That's my actual cost.
Okay.
On January 31st, 2018, the save point date, the share was trading at 200 rupees. That's the FMV.
Right.
And today, I finally sell it for 250 rupees. Let's run the formula.
Perfect. We need the higher of A, or BA is your actual cost, which is 100.
Got it.
Now let's find B. B is the lower of the FMV on Jan 31st, 2018, which is 200, or R, the sale price, which is 250. The lower of those two is 200.
Okay, so B is 200.
Right. Now, your final cost of acquisition is the higher of A, which is 100, or B, which is 200. The higher is 200.
Awesome.
So your grandfathered cost of acquisition is 200 rupees. You only pay tax on the gain from 200 to 250. The profit from 100 to 200 is completely protected by the save point.
That is brilliant. So essentially, the government says, we will just pretend you bought it for 200.
Exactly.
What about cost of acquisition for bonus shares and rights?
If bonus shares were issued before April 1st, 2001, the COA is the FMV on April 1st, 2001. If they were issued after April 1st, 2001, the cost of acquisition is strictly nil. Zero.
Because I didn't pay for them.
Right. You got them for free from the company, your cost is zero. When you sell them, the entire sale price is essentially profit. Similarly, if you renounce a right to subscribe to shares, the cost of acquiring that right is nil. For inherited assets, as we discussed, the COA is the cost to the previous owner.
Okay, so that's the base cost of acquisition. But what about indexation? Adjusting that cost for inflation over time using the cost inflation index. The Finance Act of 2024 completely changed this landscape, didn't it?
Flag this for the exam. It is the biggest structural change in the chapter, and it honestly shocked the markets.
What happened?
Historically, long-term capital assets got the benefit of indexation. You could multiply your cost by the Cost Inflation Index, or CII, published by the government, to artificially raise your purchase price, adjusting it for inflation, which mathematically lowered your taxable profit.
People love that.
They did. However, for any transfer of a long-term capital asset on or after July 23, 2024, the indexation benefit is no longer available across the board. with one massive exception.
Wait, why did the government kill indexation?
To simplify the tax code and bring Indian taxation in line with global standards, where nominal rates are lower but applied to unadjusted gains. But the outcry was massive, so they instituted an exception. Indexation is only available for land or building, or both, acquired before July 23, 2024.
So if I buy equity shares today, no indexation. If I buy a house after July 2024, no indexation. It only applies to real estate bought before the cutoff date.
Correct.
How does the indexation formula actually work for those grandfathered properties?
It's a two-step fraction.
Yeah.
You take your original cost of acquisition and you multiply it by your ratio. The CII of the year of transfer divided by the CII of the year the asset was first held, or 2001-02, whichever is later.
Give me an example.
The text gives an illustration. A house bought for 50 lakhs in 2002-03, sold in 2020-21. You multiply 50 lakhs by the CII of 2020-21, which was 301, and divided by the CII of 2002-03, which was 105. That mathematically inflates the 50 lakh cost to an index cost of 1 crore 43 lakhs 33,333 rupees.
Which massively reduces the taxable profit, saving the seller a fortune. That's huge. Okay, the third and final deduction on our receipt is cost of improvement, the COI. If I add a new floor to my house, that's a capital improvement. Are there any restrictions on what I can claim here?
Yes, there are a few. First, ignore any improvement costs incurred prior to April 1st, 2001. Those are legally ignored.
Okay.
Second, the cost of improvement for goodwill of a business, or a right to manufacture, or a right to carry on a business, is statutorily taken to be nil. You cannot improve a patent in the eyes of the tax code.
That makes sense.
Third, for market-linked debentures or specified mutual funds, no cost of improvement is allowed to be deducted whatsoever. Finally, you cannot double dip. If you already claimed an expense as a deduction under income from house property for repairs or profits from business, you cannot claim it again as a cost of improvement under capital gains.
Okay, that covers the standard computation, but Section 8.5.1 has a terrifyingly dense section on foreign currency conversion for non-residents. What is the process here, and why does it exist?
It exists to protect foreign investors from getting destroyed by currency fluctuations.
How so?
If a non-resident Indian buys Indian shares using US dollars, and the rupee heavily appreciates over the next 5 years, they might show a massive profit in rupees, but an actual loss in dollars. Taxing them on the rupee profit would be unfair.
Ah, I see.
So when a non-resident except an FII who have their own rules sell shares or debentures of an Indian company, the capital gain must first be computed in the foreign currency they initially used to buy the asset.
Walk me through the mechanics. How do they actually do that?
It is a meticulous 5-step process. Step 1. Convert the sales consideration into foreign currency using the average rate of exchange on the date of transfer.
Okay, average rate.
Step 2. Convert the cost of acquisition into foreign currency using the average rate on the date of acquisition. Note that indexation is not available in this scenario.
Got it.
Step 3. Convert the expenditure incurred into foreign currency using the average rate on the date of transfer. Step 4. Do the math. Subtract the cost and expenditure from the sales consideration to get the capital gain in pure foreign currency.
And the final step.
Step 5. Now reconvert that final capital gain back into Indian rupees using the telegraphic transfer, or TT, buying rate on the date of the transfer.
And the text says the average rate they use is computed by dividing the aggregate of the TT, buying and selling rates, as adopted by the State Bank of India, right?
Exactly. SBI TT rates are the ultimate benchmark for these conversions. Okay, we've done the math. We have our final taxable capital gain number sitting at the bottom of the receipt. Segment 6, the tax bite. Section 8.5.2, what percentage is the government actually taking?
Let's split this into short-term and long-term. For short-term capital gains, or STCG, if the gain falls under Section 111A, which covers equity shares, units of equity-oriented funds, or equity-oriented high-premium ULIPs, where STT is paid, the tax rate is a flat 20%.
Okay, 20%.
For all other short-term capital gains, like selling a physical gold bar after 6 months, the amount is added to your income and taxed at your applicable slab rates. If you are in the highest bracket, you are paying 30% plus surcharge.
So ASTT paid equities get a concessional 20%. Everything else is your standard income tax bracket. What about long-term?
For long-term capital gains, or LTCG, thanks to the recent simplification, the general rate is now a flat 12.5% in respect of all categories of assets.
That's a nice flat rate. However, there is a crucial exemption threshold for listed equity shares, equity-oriented funds, and high-premium ULBs that have suffered STT. Long-term capital gains exceeding 1,25,000 rupees will be taxed at 12.5%. The first 1,25,000 rupees of gain is completely exempt from tax.
Okay, 12.5% is the new standard. But you mentioned a massive exception for real estate earlier regarding the removal of indexation. Flag this for the exam, please, because the text spends a lot of time on this specific scenario.
Flag this immediately. This is the transitional provision for real estate. We are talking about immovable property held as a long-term capital asset.
Okay.
If the property is acquired after July 23, 2024, it's simple. You pay 12.5% tax on the raw profit without any indexation benefit.
Simple enough.
But if the property was acquired before July 23, 2024, but transferred after this date, the assessee has a choice. A parallel calculation must be done.
Let me make an analogy here to see if I grasp this conceptually. It's like walking up to the checkout at a supermarket, and there were two different lanes with two different cashiers.
I like this.
The cashiers are calculating your bill using completely different mathematical formulas, and the store manager says you can go through both lanes, look at both receipts, and you only have to pay whichever bill is cheaper.
That is an incredibly accurate analogy. Let's look at the two lanes the store manager is offering. Lane 1. The old provision. You calculate your capital gain taking indexation into account. You inflate your purchase price based on inflation, which significantly lowers your taxable profit. But the tax rate applied to that smaller profit is higher. It's 20%.
Okay, and lane 2.
Lane 2, the new provision. You do not use indexation. You just use your raw purchase price, which means your taxable profit looks much, much larger. But the tax rate applied to it is only 12.5%.
So I just picked the cheaper one?
The law explicitly states that if the tax payable under Lane 1 at 20% with indexation is lower than Lane 2 at 12.5% without indexation, the calculation based on indexation will apply. You paid the lower amount.
But wait, is there a catch? What if lane 1, the indexation lane, is so good that inflating my cost actually makes it look like I sold the house for less than my inflated cost? What if it shows I made a loss? Can I claim that loss and offset it against other income?
You found the catch. The text explicitly states that effectively any loss calculated due to indexation will no longer be allowed. You can use the indexation lien to bring your tax liability down to zero, but you cannot carry forward a paper loss created purely by the inflation indexation multiplier.
Incredible. They thought of everything. Okay, we have reached segment 7. I have calculated my tax, and the number is terrifying. I am looking at a massive check I have to write to the government. I am practically begging you, is there any legal way I can reinvest this money to avoid paying this tax entirely?
There are escape routes, carefully mapped out in Table 8.5. These are the exemption provisions. But, as agreed, the ultimate no summary rule is in effect. We are going to march through all 10 exemption sections. I will detail who is eligible, the original asset sold, the new asset required, the strict time limits, and the exact exemption amount.
I am ready. Give me the context for each one. Let's go down the list.
Let's start with Section 54. Who is eligible? Individuals and HUFs.
Okay.
Original asset sold, a long-term residential house property, new asset required. You must invest the capital gains in one residential house in India.
Why just a house?
The government wants to encourage home ownership and mobility. If you sell your house in Delhi to move to Bangalore, they don't want to tax your ability to buy a new home. Note, if the capital gains do not exceed 2 crores, you can invest in 2 houses instead of 1, but this is a strict once-in-a-lifetime option.
Good to know. What's the timeline?
Time limit. You must purchase the new house 1 year before or 2 years after the date of transfer, or construct a new house within 3 years. Exemption amount. Lower the capital gains or the amount invested in the new house, capped at a maximum of 10 crores.
So if Mr. Sharma sells his house for a 1 crore profit and buys a new apartment for 1.5 crores within 2 years, his entire 1 crore profit is exempt. Sell a house, buy a house. Next.
Section 54B. Who is eligible? Individuals and HUFs. Original asset sold, short-term or long-term agricultural land that was used for agricultural purposes for 2 years prior.
Okay, and what do they have to buy?
New asset required. Agricultural land. Time limit. 2 years from the date of transfer. Exemption amount, the aggregate amount invested in the new land.
And the logic here?
This exists to protect farmers who might sell land in one state to buy more fertile land in another. The government ensures their working capital isn't destroyed by taxes.
Keeping farmers farming. Makes sense. Next.
Section 54D. Who is eligible? Any assessee, original asset sold, short-term or long-term land or building, forming part of an industrial undertaking that has been compulsorily acquired by the government.
Compulsorily acquired, like eminent domain.
Exactly. Imagine the government forcing a factory to move to build a highway. New asset required. Land or building to shift or set up a new industrial undertaking.
Timeline.
Time limit. Purchase or construct within 3 years from compulsory acquisition. Exemption amount, the aggregate amount invested. If the government kicks you out, they won't tax you for relocating your factory.
Okay, now Section 54 EC. I know this one is highly testable. Flag it. What is the story here?
Absolutely flag Section 54 EC. Who is eligible? Any assessee. Original asset sold. Long-term land or building.
Right.
New asset required. You must invest the capital gains in specified bonds, specifically bonds of NHAI, the National Highways Authority of India, or REC, the Rural Electrification Corporation.
Wow. Okay. Timeline.
Time limit. Strictly within 6 months from the date of transfer. Exemption amount. Lower the capital gains or the amount invested, capped at a strict maximum of 50 lakhs.
50 lakhs? And why these specific bonds?
The context is that India needs billions to build highways and electrify rural villages. The government tells wealthy real estate sellers, give us your profit to build roads for 5 years, we pay you 5% interest, and we waive your capital gains tax. It's nation building funded by real estate profits.
That's the famous 50 lakh highway bond exemption. Understood. Next is 54EE.
Section 54EE. Who is eligible? Any assessee. Original asset sold. Any long-term capital asset.
Okay.
New asset required. Units of a notified fund, though I should note, no such fund has actually been notified yet. Time limit. 6 months. Exemption amount. Lower of capital gain or amount invested, max 50 lakhs.
So it's just a placeholder.
Yes, it's a placeholder in the law for future government funding schemes.
Okay. Section 54F. I know this one is complicated because the exemption is pro rata, not a flat exemption. Break it down for me and give me a conceptual analogy.
Section 54F. Who is eligible? Individuals and HUFs. Original assets sold. Any long-term capital asset other than a residential house. So selling shares, gold, commercial property.
Okay, and what do they have to buy?
New asset required. One residential house in India. Again, the government pushing money into housing.
Timeline.
Time limit. Purchase 1 year before or 2 years after or construct within 3 years.
And the exemption amount. Here's the tricky part.
Yes, this is the crucial part. Unlike Section 54, where you only need to reinvest the gain, under 54F, you must reinvest the entire net sale consideration to get a full exemption. If you only invest a portion, the exemption is pro rata.
Okay, ship me with an analogy.
Think of your sale proceeds like a glass of water, and the capital gain is a squirt of syrup mixed into it. You cannot just separate the syrup. If you pour half the glass into a new house, you're only pouring half the syrup. So you only get an exemption on half the gain.
I love that. So what's the formula?
The mathematical formula is exemption equals eligible investment times long-term capital gain divided by net sale consideration, and the eligible investment cannot exceed 10 crores.
Let me make sure I understand that with hard numbers. Let's say Mr. Sharma sells 1 crore worth of gold and his actual profit, the syrup, is 20 lakhs. To avoid all tax on that 20 lakh profit, he has to take the entire 1 crore and put it into a house.
Exactly.
If he only puts 50 lakhs into a house, which is half the total sale value or half the glass of water, he only gets an exemption on half his profit. So 10 lakhs is exempt and the other 10 lakhs is taxed.
That is exactly how the pro rata formula works.
Yeah.
If you don't commit the full principal to the new asset, you don't get the full tax shelter. Let's look at the industrial exemptions next.
Okay, hit me.
Section 54G. Who is eligible? Any assessee. Original assets sold. Short-term or long-term assets of an industrial undertaking in an urban area.
Okay.
New asset required. Assets to shift the industrial undertaking to a non-urban area. Time limit, 1 year before and 3 years after. Exemption amount, amount invested.
And the logic.
Urban centers are heavily congested and polluted. The government uses tax breaks to incentivize massive factories to relocate to rural areas, bringing jobs with them.
Smart. Next.
Section 54GA. Who is eligible? Any assessee. Original asset sold. Assets of an industrial undertaking in an urban area. New asset required. Assets to shift the industrial undertaking to a special economic zone, or SEZ.
Okay, similar timeline.
Time limit, 1 year before and 3 years after. Exemption amount invested.
Same logic as the last one.
Similar logic, but here the goal is pushing factories into SEZs to boost exports and earn foreign exchange.
Okay, we have 2 left. Section 54GB.
Section 54GB. Who is eligible? Individuals and HUFs. Original asset sold. Long-term residential property, either a house or land.
And what do they buy?
New asset required. Equity shares of an eligible startup company. The company must then use that money to buy new assets.
Oh, wow.
Time limit. To buy shares before the due date of furnishing return. For the company to buy new assets within 1 year from the subscription of shares.
And the exemption?
Exemption amount. Pro rata formula. Identical to the water and syrup concept in 54F. Investment in new asset times capital gain divided by net sale consideration.
That's a fascinating one. The government is literally saying, sell your house, fund a tech startup, and we won't tax you. It's a massive push for venture capital at the retail level.
Exactly. And the final one, Section 115F.
Let's bring it home.
Section 115F, who is eligible? Non-resident Indians or NRIs. Original asset sold. Long-term foreign currency assets like shares of an Indian company, debentures of an Indian public company, or Guidefoot securities purchased in foreign currency.
And what do they buy?
New asset required. Shares of an Indian company, debentures of an Indian public company, or government securities. Time limit, 6 months.
And the exemption?
Exemption amount. Pro rata formula again. Investment in new asset times capital gain divided by net sale consideration.
And why this one?
This is purely designed to keep NRI money sticky. If you sell Indian assets, don't take your dollars back to London or New York. Reinvest them in another Indian asset, and we will waive the tax.
Brilliant.
And that completes Table 8.5. You have successfully navigated every single exemption without a single summary.
I am taking a massive deep breath. We actually did it. We started with the basic fundamental definition of an asset saving my sofa from taxation but trapping my M.F. Hussein painting.
We did.
We mapped out the complex timelines for short-term versus long-term, survived the bizarre extinguishment and relinquishment transfer definitions, walked through that grueling top-to-bottom computation receipt, navigated the new 2024 tax rates and the supermarket checkout lanes for real estate, and finally charted all 10 exemption routes.
You are thoroughly prepared for this chapter. You understand the what, the how, and most importantly, the why. But before we close this study session, I want you to look at this not just as an exam candidate, but as a financial professional analyzing macroeconomic policy.
Okay.
Look closely at the exemptions we just meticulously covered. Section 54 pushes money into housing. Section 54 EC funnels capital directly into NHAI highway bonds and rural electrification. Section 54 GB incentivizes you to fund eligible startups.
Right.
The tax code isn't just a rigid formula for the government to confiscate your wealth. It is a sprawling, incredibly detailed map of the nation's economic priorities.
Right.
The government is essentially saying, we will let you keep your wealth, but only if you deploy it to build the infrastructure, the housing, and the businesses that India desperately needs for tomorrow.
That entirely shifts how I view this chapter. It's not just a penalty, it's a redirection of capital. It's social engineering through mathematics. Next time you calculate capital gains, ask yourself, whose goals are you really funding? Well, to everyone listening, thank you for sticking with us through the mud. Good luck on your NISM Series XBXB exam preparation. Keep reviewing those exam flags, remember the analogies, and we will see you on the next deep dive.